FinTech, the hottest new industry, or maybe not so new. You might have heard about it. But what is it, and how is it disrupting the banking industry? Well, when we think of traditional banks, we typically think of those old buildings with vaults full of gold. But modern banks are more like giant data centers. Banks collect our deposits and then use that money to make loans and investments, all based on numbers in a computer system. It's just that simple. And this makes it easy for us to lose sight of the fact that these institutions are still businesses. They still need to make money. And they've become very good at doing it through fees, overdraft charges, monthly maintenance fees, interest rate markups. The list goes on. This is where the new wave of financial technology, companies or fintechs are challenging the status quo. They're offering better, cheaper, faster services and sometimes even free. Of course, there's nothing new about technology improving the banking business. Online banking was a huge development back in the late 1990s, but recent advances in areas like mobile computing and artificial intelligence are opening up a whole new world of possibilities. Take payments, for example. It used to be that if you wanted to send money to someone, you'd have to write a check and mail it or deposit the cash into their account in person. Then came online payment platforms like PayPal and Venmo, which made it easier than ever to transfer funds. But still, if you want to pay someone who isn't using the same platform, you'd have to enter a series of numbers, a username, or an email address. But a new generation of apps is making this even simpler by allowing users to pay each other instantly by just entering their phone number. Services like this remove the need for the middleman, cutting out the bank altogether and saving customers money. But that's just one example. There are dozens of other ways that fintech companies are shaking up the banking industry. Let's take a look at a few more. Lending. Banks have long been the go-to source for loans. But fintech companies are now offering consumers and small businesses more convenient and less expensive alternatives. One way they're doing this is through peer-to-peer lending platforms, which allow individuals to borrow money from other individuals rather than a bank. These platforms typically have lower interest rates than banks because they don't have the same overhead costs. Another way that fintech companies are disrupting the lending industry is through the use of alternative data sources. Banks traditionally rely on credit scores to determine whether or not to lend money and how much interest to charge. But these scores can be inaccurate since they often do and take into account all of a person's financial history, especially if they're a new borrower. Fintech companies are using new data points like mobile phone usage patterns or utility payment history to get a better sense of a person's creditworthiness. And it's not just individuals who can benefit from these new lending platforms. Small businesses are often turned down for loans because they don't have the necessary collateral. But some fintech companies are using invoice factoring to make it easier for small businesses to get the capital they need. With invoice factoring, a company sells its outstanding invoices to a third party at a discount and receives the cash it needs upfront. This allows them to keep more of their profits and reinvest in growth. There are even fintech companies that are completely changing the way we think about money. For example, some are offering accounts that pay interest on a daily basis instead of a yearly basis. Others are allowing customers to round up their purchases to the nearest dollar and then invest the difference automatically. So, whether you're a consumer or a business, there are a lot of new options to consider when choosing a financial service. Now, of course, this doesn't mean that traditional banks are going away anytime soon. Still the dominant players in the market, and they have the advantage of name, recognition, and trust. But they do need to be aware of the competition and be willing to innovate or risk being left behind. In fact, some banks are embracing the changes and partnering with FinTech companies to offer their customers the best of both worlds: the convenience and innovation of new technology with the stability and security of a well-established institution. Only time will tell which approach will come out on top. If you liked this video, give it a thumbs up and subscribe to our channel for more informative content. Thanks for watching.